JJ the CPA here. Hope you're doing well. Thanks for tuning in. PPP 3.0 is not a government program. It's your program. Here's 3 things you need to be doing. So hats off to Bill, my great friend that I had a discussion with yesterday about this very issue. Thanks, Bill.
Yeah. JJ, the CPA is here.
Just to be clear, PPP 3.0, Paycheck Protection Program. That's what PPP stands for. And yes, we would all equate that to the government program of PPP 1.0 right now, August 11th. We are still waiting to see if there's going to be a PPP 2.0, but PPP 3.0 needs to be your own paycheck protection program. You can create your own. How? Simple. I mean, it's just saving money. So this isn't a how do you go get money from the government. This is 3 things that you need to be doing so that if we hit something like this again and or you're down for 2 weeks, something happens with your business, your location, there's construction in front of it, you're sick, you become partially disabled. Pick all the things that we never want to think about, especially as an individual, an employee, a small business owner. We need to be prepared. So it's easy stuff, but you know what? We don't hear enough about it. We definitely haven't heard anything about it this year. It's stuff that we all know. So the 10% rule, right? So whatever money's coming in, even if right now it's not as much as it usually is, set aside 10%. It's something, right? It's something. So set aside 10%. The second thing is to actually open a savings account if you don't already. A business can have a savings account. So if you own a business, you can open a savings account in the business. So it doesn't really yield any interest nowadays, right? The interest that it's going to earn out of bank, it's nothing. So you're not doing it really for that purpose. What you're doing it for is to set aside money, literally. So that 10% we're talking about you setting aside, whether you're the individual setting money aside or the small business owner setting money aside, have a savings account for that. If you're a small business owner, you're saving money in your business, but you should also be saving money at the individual level. So having 2 separate savings accounts makes sense. The reason is out of sight, out of mind. It's not part of your balance. It's easier to, when you set the money aside, to not then touch it. The third thing is actually saving whatever you already have saved, especially retirement. So Paycheck Protection Program isn't just about your emergency or something went wrong. Paycheck Protection Program long-term is protecting your paycheck in retirement. So the third thing to PPP 3.0 is that you don't use your retirement at all until you retire. So you have current issues going on, individual, small business owner, you don't touch retirement. Retirement is not a savings account. It's a retirement account. Don't think of it as a savings account. If you meant for it to be, well, I'm going to set aside for retirement, and then if I need it, I'm going to get it. Don't do that, because when you pull money out of retirement, you pay a penalty. Now, yes, this year, up to $100,000 because of the CARES Act, that you pull out of a qualified retirement account, IRA, 401k are the most popular ones, up to $100,000 if it's due to COVID reasons, you can pull it out and not pay the 10% penalty. Okay, great. But guess what? You're still paying tax on that retirement that you're pulling out. So you pull out $10,000, you're going to pay $2,000, $3,000, maybe $4,000 in taxes, depending on your tax bracket. Yes, you don't have to pay the 10% this year, but even in future years, if you have to pay the 10%, that wouldn't be a reason to not or to actually pull money from retirement. Don't pull money from retirement. That's a way that you're protecting your paycheck in retirement. Now, you could get very technical and say, well, I don't have a paycheck in retirement. Well, yeah, you do. You've been saving up to pay yourself some money. So a paycheck is a term that we use that we mostly equate to wages, but a paycheck in the terms of you making money, or as I would say, having money to cover your expenses. It's a paycheck of some kind, whether it's a dividend, retirement distribution, wages, interest, whatever it is, okay? That's your paycheck. That's what you live on. So at the end of the day, it's three things. Set aside 10%, simple. You got $1,000, set aside 100, right? Use what's left, the $900 in that example, to pay what you have to. Save that $100, okay? Set up a separate account. So many do not. I don't know the percentage, but if I were to guess, 75% of Americans don't even save. So at least 75% of Americans don't have a savings account. So set up a savings account. Put that 10% in there, and then anything else you can save, put it in there, right? You have a coupon, you save $3, sounds silly. Put the $3 that you saved in that savings account. You got an extra windfall, put it in the savings account. Some of this money that comes about potentially and hopefully of the stimulus, put it in the savings account. Okay, the $1,200 that comes, when it arrives, it's now not Yahtzee money. Save it. The PPP, the EIDL. And then third, don't use your retirement. Save it, right? The money that you've put in, even if you didn't put another dime in, save it. The money that you're putting in, yes, you should keep putting money in. If you stop putting money into retirement, maybe a paycheck, payroll period, 1 or 2 payroll periods maybe is okay, but don't get in some habit of it, because guess what? You have that money and then it's like, oh, well, we can go out to eat. Oh yeah, we can go ahead and get this, we can get that. Then you're affecting your retirement. This is the time to still keep saving for retirement. The market's low, right? So you're actually getting probably more stock. So it's not timing the market, it's time in the market. You want your money into the retirement. And even if your money's not in the market and it's in bonds, or it's just sitting in a money market in retirement, right? Don't touch it. Regardless, don't come up with excuses and reasons to be able to pull money out of retirement. You don't touch it. You go get a loan first, right? You don't pay your rent first. You don't pay and you pick it. Now, I understand there's repercussions to that. We're talking short term, but your not paying rent is a short-term decision where if you're using retirement, that is a long, look at how long it is. You can't even see the end of it. That is a long-term decision, okay? Long-term decisions, okay? Do not make short-term decisions that affect you long-term. Figure out how to pay that rent differently, whether it's a government program or letting the landlord you can't, let them know you can't pay it. Maybe you got to move. Touching retirement should not be an option for you at all. All right, hey, PPP 3.0 is your PPP. You coming up with it. You don't need to rely on the government. You never have, most likely. Or if you did, it was in rare circumstances. We've all been relying on the government now. Yes, we should get PPP 2.0 if they pay it out. Yes, you should get the relief that you deserve. But you should still be doing these other things right now. Okay? All right. Hey, thanks for tuning in. And I always forget to ask you this at the beginning, but if you've not subscribed to my YouTube channel, please do click subscribe, hit those notifications, thumbs up if you've made it to here. And don't you ever forget, you've never met a CPA quite like me. And by the way, Bill, thank you for the idea of PPP 3.0.